Buy the dip? Macro, markets, and trading perspective. Today we're seeing markets react to a mix of geopolitical headlines, economic data, and shifting expectations around interest rates. Oil prices are pulling back sharply after a strong move higher, reminding us once again how sensitive energy markets are to political risk and speculation. Whenever oil spikes on geopolitical fear and then quickly reverses, it tells us something important. The market is reacting emotionally first and rationally later. Traders rush in on headlines, and once the immediate fear fades, price starts to reassess reality. From a bigger picture perspective, oil still matters far beyond just energy traders. Rising oil prices feed directly into inflation. Transportation costs go up, production costs increase, and those pressures eventually show up in consumer prices. That's why central banks watch oil closely, even when they don't talk about it directly. At the same time, recent U.S. labor data has come in stronger than expected. Fewer people filing for unemployment claims signals a labor market that remains resilient. When employment stays strong, central banks feel less urgency to cut interest rates aggressively. This creates a push and pull in the market. On one side, inflation is not accelerating dramatically. On the other side, growth and employment are not slowing enough to force immediate rate cuts. That uncertainty keeps markets volatile. Gold has reacted to this shift as well. When yields rise, gold often struggles because higher yields increase the opportunity cost of holding non-yielding assets. That doesn't mean gold is suddenly bearish long-term, but it does mean short-term momentum can weaken when yields move higher. Bond yields, especially shorter-term yields, are one of the most important signals traders often overlook. They reflect expectations about future central bank policy. Rising short-term yields suggest markets believe rate cuts may be delayed. Falling yields suggest easing is closer. Equity markets, however, continue to show strength, particularly in specific sectors. Semiconductor stocks have become the backbone of the broader market rally. When you see large-cap technology and chip makers driving gains, it tells you where institutional money is flowing. Not all tech stocks are equal. While semiconductors continue to outperform, other areas like software have lagged behind. This divergence is healthy. A strong market is not one where everything goes up together, but one where capital rotates into the strongest opportunities. Small-cap stocks are also starting to show signs of life. When smaller companies begin to outperform, it often signals improving economic confidence. These companies are more sensitive to borrowing costs and domestic growth, so strength here can be a positive sign for the broader economy. That said, buying at or near all-time highs always comes with risk. The correct mindset is not blind optimism, but controlled participation. If markets continue higher, you stay in. If momentum breaks, you step aside quickly. This is where disciplined risk management matters. Being bullish does not mean being careless. Stops exist for a reason, especially in environments driven by headlines and macro uncertainty. Sentiment is another key factor traders must respect. When crowd sentiment becomes extremely bullish, forward returns often become less attractive in the short term. That doesn't mean a crash is coming, but it does suggest caution. Markets rarely reward everyone at the same time. When optimism reaches extremes, the market tends to slow down, consolidate, or correct before continuing. Currencies are reflecting this uncertainty as well. The US dollar is not clearly bullish or bearish right now. Some data supports strength, while other data points to weakness. This kind of mixed environment usually leads to range-bound trading rather than strong trends. In these conditions, flexibility matters more than conviction. Traders who lock into one bias often struggle. Traders who adapt tend to survive. Crypto markets are showing similar behavior. Momentum-driven, emotionally charged, and highly sensitive to sentiment. Crypto tends to perform best in strong risk-on environments, and struggles when uncertainty increases. Bitcoin in particular moves in cycles of excitement and neglect. When price accelerates, everyone wants exposure. When price stalls, interest fades quickly. That makes it a trading vehicle rather than a long-term macro hedge for many participants. Right now, crypto sentiment is leaning optimistic, which from a contrarian perspective suggests caution. That doesn't mean short immediately, but it does mean being selective. Across all markets, the same principle applies. Strong moves are usually followed by consolidation or pullbacks. Buying dips works best when the broader trend is intact and momentum remains healthy. Blindly buying every dip without context is dangerous. Smart dip buying happens near key levels, with confirmation and with defined risk. Markets are not about certainty. They are about probability. And probabilities shift as data, sentiment, and positioning evolve. The traders who last are not the ones who predict perfectly, but the ones who manage risk consistently and adapt as conditions change.